Welcome to the Techno Fundamental Report for November the 30th. Let's talk about dead industries. This is the New York Central Railroad Company stock certificate. You know, the railroads just flat went out of business. You know, the passenger rail industry got replaced by the airlines. The only thing we have now is Amtrak was a government subsidized business, but it's a failed industry. So one of the quotes here is the way to become rich is to put all your eggs in one basket and then watch that basket. So if you put all your money in the railroads, you better have watched it closely as it fell apart, basically. You know, Gerald Loeb wrote a book in 1935, got his clients through the Great Depression. And I'm going to paraphrase this, not read the whole thing, but his main point is that just like the railroads, people hung on to these companies because they paid a dividend. Now, when a company pays a dividend, it depletes cash flow. Cash goes out the door, never to come back again. And it's basically saying that the company no longer is growing, usually is the case, and they send money out instead of reinvesting in the company. Now, what Loeb says here, he says trying to get a stated income from dividends, interest, or both of 3, 4, 5%, or whatever it is, really amuses me because of the simplicity of the point of view displayed. So it's just not that simple. He goes on to say, he says, my feeling is that an intelligent program aimed at doubling one's money might at least succeed in retaining one's capital or actually making a profit with it. So you have to set your goals high. When you look at a company, I really think you need to have the attitude of, I can double my money in this stock within, say, 3 to 5 years. One quote that is really stuck in my mind here is this is by William O'Neill, is one of the great paradoxes of the stock market, that what seems too high usually goes higher, and what seems too low usually goes lower. You know, it's really a true quote. I'm just saying, after doing this as long as I have found that once you get that upward trend and that, stock prices tend to trend. Now, Warren Buffett, Charlie Munger passed away yesterday, and what a great man he was. He had some interesting stories, but Buffett says here, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. So if you think we're going into a new bull market, which I believe we are, I think you need to get the buckets out. Investing in stocks is an art, not a science, and people who've been trained to rigidly quantify everything have a great disadvantage. In other words, there's an academic schools out there and business schools out there that teach you these fundamental PE ratio type of things that really put you at a disadvantage, because basically what you want to focus on, like Peter Lynch says here, stock prices follow earnings. You want to follow earnings, and we are wrapping up earnings season. Now, what you want to look for, I believe, is the best opportunities are the ones that are pretty incalculable. In other words, think about Walmart when it first started out in the 1970s. No one dreamed that they were going to bring in the business that they brought in. Now, currently, this is a picture of a data center, which has to do with artificial intelligence. Now, it's a technology that I think is incalculable. You really don't know where this thing is going to go. And the reason this is important is that the market's efficient. You've got all these analysts out there doing these projections. So think about it. Let's say you're in the building airplanes. You can only build so many airplanes. Or let's say, so it's calculable. You can calculate it. Analysts can calculate it. There's a lot of industries like that. You should just be aware of it. Now let's talk about interest rates. Here's the mortgage, 30-year mortgage. You can see here we're getting somewhat of a drop here. I'm hearing from the experts that they think the mortgage market's going to stabilize in the 5 to 6% area, which would be down in here. So it looks like interest rates, if you look at what's going on with the power index, it's definitely in a downtrend. We've got the lowest reading we've gotten in a while, and this is the 5-year Treasury note yield, and it's dropping pretty dramatically. It's in somewhat of a downtrend. You can see it also here in the 5-year. In this graph, look how dramatic the drop in interest rates are. So the main thing is, back in the 70s, and this is the only time that I can think of that's comparable to where we are now, back in the 70s, we had hyperinflation. We had 70% income tax rates, unearned income tax rates. It was a very difficult period, but you think about what happened back then. They raised interest rates dramatically. because inflation came back. So that's what we have to really keep an eye on, is the inflation problem behind us. Now here's just some more interest rate graphs. I thought this was important here. Here's the 2-year, here's the 5-year, and here's the 10-year. You can see all three of these government securities, the yields are dropping. So it's basically saying that interest rates may have peaked. If inflation doesn't come back, we're going to be in good shape here. Now, the volatility index, I wanted to point this out. This is the fear index. It measures volatility using options. So when the institutions are doing heavy call buying and no put buying, the VIX gets very positive. And you can see here the VIX is at the lowest reading we've been at in a long time. So it's really confirming the rally that we're in right now. Here's the aggression index, where we're looking at the NASDAQ versus consumer staples, hitting a new high for this particular move, which is a very big positive. We're seeing the growth stocks are starting to outperform. Now, here's our three economic indicators. Again, you can see what's happening with interest rates. This is the price of oil. Price of oil's in a downtrend below the 200-day. And the good news here is the banks are really benefiting from these lower interest rates. You can see how the bank stocks are starting to rally. The other indicator that we think is important is the number of new lows on the New York Stock Exchange. We want to see an extended period of time where it's below 40 a day, because that means to us that the sellers are drying up. In other words, back here in October, November, the sellers were dominating and the market was dropping. Now it looks like maybe we're seeing where the sellers have done their work. This is the ARK fund. This is a very growthy fund. Now I'm just saying, you really cannot have a bull market without the growth stocks. This is a very growthy fund, and you can see it has definitely gone into an uptrend and has broken out again, so looking very positive. This is the regional banks. Again, I wanted to point out the banks are looking like they're coming out of their doldrums and looking much better. So if you have any questions, please let me know. Thank you very much.